So moving on to compensation, I think, and if you read the Wall Street Journal and you hear about how the top 100 boards and the median compensation is over $300,000 a year, it starts to feel like a get rich quick scheme here. But the reality is that it's like saying, I want to be a director to make money. It's like saying I want to play basketball because I want to earn as much as Steph Curry does. Right. So there's definitely a range of compensation for board work. And there's only a few companies that are in that category of the top 100 public companies in the country. So David, can you talk a little bit about kind of the range of compensation and what are realistic ways to think about what the compensation for this role should be?
Right. So the compensation can vary widely, mostly based on company size, but also based on industry and so on. If you look at NACD data, the range for the smallest public companies to the biggest can go anywhere from around $140,000 total per year, all the way up to north of 300,000, as you mentioned, Kris. So there's a wide range there. And then if you look at private companies, who in general tend to be smaller, but also are subject to less external scrutiny, and frankly, in many cases aren't bringing outside experts in because they don't have that external scrutiny to try to assess what level is competitive, those pay levels could get lower still, and median ranges for those companies may be anywhere from $30,000 to $60,000 annual retainer for some of the smaller organizations. So it's a wide fairway.
Now, how about the questions of cash compensation versus some kind of equity or long-term incentive? What do you see there?
Well, so director compensation in general is much simpler than executive compensation. You don't see incentive schemes. You don't see a lot of moving parts. And in fact, over the last several years, the trend has been towards fewer moving parts for public companies, at least. Equity and cash retainers are the two most common pieces for public companies. And you will find that on any public company board, certainly, you'll see an expectation that you'll be holding a reasonable amount of equity over time to ensure that alignment with shareholders. So you will probably have a meaningful portion of your compensation provided in equity with that intent in mind, that you'll have that direct alignment with the folks whose interests you're supposed to be looking out for and overseeing management.
And is there a standard as to how much equity a director should hold?
Well, so the typical guideline is somewhere around 5 times whatever the annual cash retainer is on the board. So if you look at NACD best practice guidelines, the general rule of thumb is that director pay should be in the form of cash and equity, with at least 50% in the form of equity. And the reason that you provide compensation in the form of equity is so that it's easy to get to those levels of ownership without going out and writing a check. So generally speaking, on a public company board, you may be expected over the first 5 years that you're on the board to build up a level of ownership equal to about 5 times what the annual cash retainer is. And you should be able to get there simply by holding the after-tax proceeds of the shares that you're granted.
And if you, what about equity like awards in private companies?
So it's really a minority practice. The last data that I saw indicated probably about 20% of private companies may have some real equity device. And those are mostly in organizations that are not really family controlled, maybe more private equity backed, or private going concern private companies that have been around for a long time, have an established equity program, maybe for some of their employees as well.
I do find it interesting. Also, there's some, certainly as we were planning this panel, one of our fellow directors was talking about an expectation of actually purchasing stock above and beyond what you would be awarded or given with board fees. And in private equity deals, often there's an opportunity to invest alongside that's discretionary, but is really a signal of commitment to the company and commitment to the vision for the company. So I think it's worth any of our listeners knowing that there are moments in board service where you might be investing more money than you're taking out at any point in time.
Right. And to one of your prior questions, Kris, I think one of the things I'd want to understand coming in as a director is what that expectation is regarding the amount of ownership that you're expected to maintain. Because I know for some new directors at some conversations I've had, it's been a surprise, or not everybody has the ability to hold a certain amount of equity for a long period of time. So that's something that you'd want to understand coming in as well.
By the way, to that point of holding it, like your ability to actually liquidate a position is something that public companies especially may frown upon at certain times. And so even though you think that you should be able to sell, you might not be able to. Or separately, I know some people have tried to get margin loans against their stock. And in a lot of public companies, that's just flat out, most public companies, that's just flat out prohibited.
Yeah.
If I can just add a point, David, your comments were extremely helpful for the following point. My experience is very often as individuals are beginning to think about transitioning from a full-time executive position to either a single board in addition to their executive president, but more often than that, pivoting completely into a professional board type role, they haven't really thought through everything that David just mentioned. And what I mean by that is there are very serious cash flow implications, right? Stock versus cash, which obviously everyone is different. Everyone has their own financial planning, but you really need to think through the time it might take you to get on a board. So if you leave an executive position, hoping to get on a board, what's the gap? But more important than that is just, does this combination of board positions on an after-tax basis, once you pay the tax on the equity, does it give me the cash flow that I need to sustain a certain lifestyle? So all of this needs to go, in addition to the D&O insurance, for example, that Travis was talking about earlier, all of this has to go into your calculations as to whether board service is right for you at this moment in time.
And to that last point, if you are relying on one board position to maintain your standard of living, there is a big question of whether you are independent of management, because if they decide not to reelect you, then you have lost your potentially sole source of income. If your decision is later challenged by a court and they find that out, particularly if you didn't tell anybody that in the first place, that can come back to bite you. So you do not want to find yourself, unless either you're an employee director or you're okay with not being truly independent of management, being reliant upon that single directorship for your livelihood.
And building on that, I think you can't even say, oh, here's a typical board, a typical healthy board, you can serve 10 years or so, right? So if I get 3 boards and I'm on each one of them for 10 years, right, this is what it looks like. Because what happens, right? The company gets sold. The company decides to refresh the board, right? And they're proactive and have different needs over time. If it's a private equity board, they're sold, and you get out and don't have a board seat, or they don't sell and your money's tied up for much longer. So it is an unpredictable portfolio that way. And It's important to keep that in mind. There's a question about private equity board compensation, and how that and what's typical from a private equity perspective, and also to comment on whether it makes sense to take your meeting fees as stock if that option is available.
So thank you, Kris. I'll take the first question on private equity. It's difficult to identify private equity trends because private equity deals can vary so much from one firm to the next, and the exit strategy for the particular situation. Generally speaking, I think you have more opportunities there to buy in than you might elsewhere. But I'm not aware of any big overarching trends in private equity director compensation to identify. As far as taking compensation in the form of stock versus cash, There are a lot of companies that offer this, offer the opportunity to defer a portion of your pay or take a portion of your pay in stock, usually in part as a way to facilitate building ownership, as we talked about before, which is important on a lot of public company boards. But in some cases also to allow directors an opportunity to better plan or time taxable events. So you'll be able to take your equity in the form of units that you can defer to a future date. And there are a lot of directors that choose to take that route, in part because it satisfies both of those considerations. One, you're building ownership and you kind of set it over here and you don't have to think about it. And you're also sort of, as part of your financial planning, timing when you're going to actually have to recognize that income.
Yeah.
One thing just to
Thank
hit
you.
on the private equity point is that not all equity is created equal. And I'm not talking about options versus profit interest versus those types of things, but specifically, if you're in an LLC structure or something like that, where there's a waterfall, and I don't want to get into all the financial engineering, but there are very real possibilities that the company gets sold for a high multiple and you never see a dollar because the preference stack takes all of that money. There are two things about that. One, if you're the residual equity, you might never get paid. Two, if you're not the residual equity and you have the preference, you may have a conflict from the other equity holders, the stockholders that you're supposed to be representing. And so you need to think about that before you accept that equity award. A similar thing happens in SPACs, which was all of these directors got paid in units or shares or things like that of the SPAC. But as a result, Delaware has decided that a lot of them had insurmountable conflicts.
I think that's a really, really good point, Travis, because it's when you see the reported private equity results and the multiples that things trade at, they start usually with recognizing their own fees as return to their investors, right? So that is part of their multiple of what they put in the first place, but those fees come out off the top, right, before anything goes to other shares. So really understanding the structure is important.